Computer, if you want it, or to the cloud.
Everybody on Zoom hear us? Bobby, Willow,
Yes.
Sure can hear you.
I can all see the presentation?
Yes.
Rock and roll?
This thing's not working yet, but is it gonna wake up? Or I can do it over here too. either way.
I just click on. Try.
Yep, perfect. All right, everyone. Well, we'll get started. Thanks for your patience. Grant Hickman with Simple Loans. I think most of you know me. This is my new colleague here, somewhat new, Chris Barber.
Chris Barber. Yeah. Thank you for having me.
So Chris can tell a little bit about himself here. So go ahead.
Yeah, so I was born and raised in Florida. Came out here to go to high school, Nowa High School, graduated many moons ago, and moved back to Florida. Got into mortgage business after high school and stayed in it. It's just been a great industry. It really suits me. I'm a numbers guy and very specific. I'm very tight with what I do. But most and foremost, I like helping people. A lot of people have a hard time with understanding mortgages, how they work, how buying a home works, how they can refinance and buy another home, or how all those numbers come together. That's my forte. I love it. So I'm happy to be back out here in Colorado, doing it out here, and
Happy to be in Florida right now too, I'm sure.
oh yeah, yeah, very happy to not be picking up trees again, and big limbs, and dealing with water damage. So yeah, yeah. So I've been back out here for, let's see, since 2021 is when I moved back out, and joined the mortgage field out here while continuing my license in Florida as well. It's been great, basically just trying to start getting my network opened up here like I had back there after 20-something years. And it's been great working with Keller Williams, really the agents that are here. I was introduced to even prior to moving back out here. So really great company that you work for. And NOCO Empire, obviously the best, right?
Great. But most everyone knows me, but for those that don't, I've been doing mortgages for over 25 years now. Grew up in Colorado and Boulder County, been here my entire life, and just love what I do. Obviously, I wouldn't have been doing it for over 25 years. So, but yeah, we're going to do Mortgage 101s. Well, not the first time, but it's been a couple of years. I think pre-COVID, we've done these before, so it's been a while, but we're getting back into it. We're going to be doing these classes here somewhat regularly, and it's just a way to introduce you guys, update you on mortgages, or inform you about your mortgages, getting into some of the basics, but then also some of the nitty gritty for each type of loan that's available out there. So I'll let Chris get started on the first slide here.
All right. So overall, we're probably going to feed you too much information or more information than what you actually need. But you take away from it what you will, and please don't hesitate to ask questions. Some people are kind of hesitant to ask questions in the middle of a presentation or a school atmosphere. But don't, and if you are, call us afterwards. We've got plenty of cards to hand out. And of course, you're going to take home one of these pamphlets, and you can refer to that anytime you like.
And for those online, we'll get the slide deck to you as well. So,
right. All right. So the first thing we're going to go over is the types of mortgages. I just kind of assume, and I've been wrong before, once or twice. Everybody knows what a mortgage is, right?
Yes.
Because I have ran into some agents that don't know. They don't know. And not only are not knowing what a mortgage is, but then there's different types of mortgages for different situations, different scenarios. And that's very important as well, because you want to line up your buyer with the right mortgage to get them the most for what they can, right? So this is where we start. We've got these loans here are what are available through Simple Loans. And we are very proficient with them. We understand them quite well. The first one is FHA loans, is what we're going to talk about. Created in 1930s, it was the first 30-year fixed rate loan. So can you imagine having only 10-year loans options available and dealing with the price per month on that? When they opened it up to 30 years, that really allowed a lot more people to buy homes, right?
Is that because of the Great Depression?
Yes,
It's more of a standardized loan product just to kind of level everything out for everyone so they.
but when it came on,
Yeah.
it was due to the depression.
Mhm.
Fannie Mae and Freddie Mac, or conforming loans. So these are the loans that most people fit into this box, and they get the ideal rate with a specific amount down. But conforming loans are split up between two different, we'll call them organizations, is Fannie Mae and Freddie Mac. Essentially, they're government backed. VA loans, that's another type of loan that we offer. That was created after World War II and made it available for veterans to buy their first home.
And we're going to get into more details on each of these down in future slides, further slides.
Down payment assistance loans. Those are as of late. And CHAPA is a down payment assistance loan. So it assists people to get into a home that don't have the 5% down to get in via a conforming loan. And we'll talk more about that, and you can ask questions about that later on if you'd like. USDA loans. USDA loans are for rural properties, so properties that don't fit into a neighborhood. You've got a property that's got 5 acres next to a property that's got 20 acres, and then next to a property that's just 1 acre. And that's kind of a rural setting. Jumbo loans, kind of says it for itself, right? Jumbo loans, they keep raising the limit on that. Essentially, the banks have to charge a higher interest rate because it's a home that not everybody's going to be able to afford. And look at it from the standpoint, if they had to foreclose on the home, or God forbid something happened to the owners of the home, and they took the home back, sell it on the market, it's going to be harder to sell that $1.5 million home, right, than it is the $400,000 home. So they charge you, they called this a jumbo loan, and this is loans that are over $715,000. So this is a new jumbo loan amount. Prior to that, it was 487, and it went up to 543 or something thereabouts. So just recently, 715 across the board. Most of the counties involved with it. Anything over 715,000 will be considered a jumbo loan. And there's some caveats that go with jumbo loans, of course, like any loan. Portfolio loans just outside the traditional mortgage. So if you've got
Goes to sleep, I think.
if you've got a buyer that's kind of got an unusual circumstance, whether it be income, employment, credit, or the property is weird. This is what we call a portfolio loan. Right? So these are not funded by large banks. Generally, they're smaller institutions or investors that do these portfolio loans.
Just use it quicker now. She might wake up.
I'm just gonna wake it up, okay. Okay, cool, great. So, next slide here, so this is where we're gonna get into some of the nitty gritty on some of the details for FHA loans. And so FHA loans are designed for folks that have poor credit, honestly, lower credit scores. The interest rates, FHA is more lenient on the interest rates for folks that have lower credit scores. So kind of my delineation there is around 680. If they're below 680, they're probably going to be going FHA. If they're over 680 and over 700, Fannie Freddie conforming is going to be the way to go. FHA is only for owner occupied loans, not for second homes or rental properties. 3.5% down is required for an FHA loan. It's one of the big misconceptions on down payment, people think, oh, I've got to have 20% to put down in order to buy a house, and that's obviously not the case. You can get by with as little as 3.5 here, 3% for first-time home buyers on Fannie Freddie, which will be listed on the next column over. We can go down to 580 on FHA right now. Some investors, they even say 550. Technically, those are eligible. It's a lot more difficult to get loans done with lower credit scores, but as long as the underwriting system, which is a software program, approves it at a 580 score, then it'll probably fly through. So the rates are going to be better if their scores are over 620 and over 660 for FHA, but it is eligible down to 580. FHA also has more lenient credit score, debt ratio limitations. So they'll go up to 55% debt ratios, and we'll get into a little bit more of what a debt ratio is further down, but basically easy numbers is just over 50% of their income that they make can be used to qualify for total debts that they have, including mortgage payment, any other student loans, car payments, things like that. There's no restrictions on the amount of income that they make for an FHA loan. Some of the down payment assistance loans, a lot of them do have income restrictions on how much they can make in order to be eligible for the down payment assistance. Gift funds are allowed for down payment, and that's for an FHA loan or Fannie Freddie as well. So gift funds for relatives, parents, not friends, but relatives, they can gift money for folks for down payment and also use that to help cover closing costs. Co-signers are allowed, so parents can co-sign, or brothers, sisters, siblings, whoever can co-sign to get someone to be able to buy a house if their income isn't quite enough to do it on their own. And then the interest rates are typically lower on FHA loans than they are on Fannie Freddie. The mortgage insurance cost is higher, and that's mentioned here as well. So it is kind of a give and take on Fannie Freddie loans for lower income, for lower credit score folks. The mortgage insurance is more expensive, and that's where the FHA loan can come into play for lower credit scores, because the mortgage insurance is the same cost no matter what their credit score is with FHA. And then Chris mentioned a little bit about some loan limits. So FHA does have its own specific loan limits, and it's county specific. So Boulder County is a fairly high value county, obviously, as far as values are concerned. So their loan limits are higher accordingly for FHA. Up to right now, it's up to 747,500. That's going to increase likely in next year. It usually goes up every year. As the values go up nationwide, then they'll raise these loan limits up as well. But it's important to know that Larimer County is at 522 right now, 522,100, and Weld at 483,000 even. That's compared to the 715,000 that we can do with conforming right now. So that is one of the major limitations for Larimer and Weld as far as the loan limits that are allowed for the FHA. And then Fannie Freddie, I'll just glance over that really quickly. Again, we talked about the loan limit being up to 715. That's going to be the loan limit for next year. Or they're allowing us to close loans at that level because they know that it's going to be at least that amount when they finalize the number for the loan limit for 2023. And Fannie Freddie loans are for owner-occupied second homes and rental properties, not just owner-occupied like FHA. By the way, if anyone has any questions throughout this, just stop us as we're going along. I prefer it to be interactive. Just ask any questions. Same with you folks on Zoom. Just butt in and say, hey, I got a question, and we'll probably handle it better that way. So, yeah, go ahead.
What if you have a client and she can put 20% down, but her credit score is only like 605? Can she still use FHA?
She can go FHA, but
20%,
not Fannie Freddie.
Well,
So
yeah, not that. I know
yeah,
that, but
620
she
is-
can still do it and
Sure.
still with the 20%.
and if with that kind of down payment, that's going to help. That gives the less of a risk involved with that loan. So that'd be the software would probably approve that, at that kind of a credit score.
So less risk for the bank,
Right.
FHA, Fannie Mae, Freddie Mac, lower the rate.
Is this, sorry,
Yeah.
would it be a lower rate though, even though she's not up to 620?
Well, the rates are going to be based off of the credit score.
The credit
mostly.
score, that's what I
Yeah,
thought.
yeah.
It doesn't matter the down payment, it goes off the credit score.
For FHA.
For
it does.
FHA.
Yeah,
Oh, yeah.
Fannie Freddie, you do get a little lower credit score. The credit scores definitely depend on the interest rate when it's Fannie Freddie. So the lower the scores, the higher the rates are going to be. And also with down payment, the more you put down, the better the rates are with Fannie Freddie. FHA is pretty straight across the line. It's just really dependent on the.
And she still wouldn't have to have mortgage insurance.
No, you do. Thanks for saying that. Anytime you do an FHA loan, you're going to have mortgage insurance on that
No
file.
matter if.
And that stays for the life of the loan. Yep. So people will start with an FHA loan to get into something because it's more lenient, and then they'll refinance out of that into a conforming loan down the road if they can. Even if rates are the same, if the mortgage insurance, if the house has gone up in value, mortgage insurance can be dropped on that FHA, even at the same rate, their payments are gonna probably drop $200 or $300 a month.
Right,
So it makes
right.
sense for people to refinance out of an FHA loan as fast as they can, really.
Okay.
As I mentioned, 3% down for Fannie Freddie, 10% down for second homes, and it says 20 to 25% down for rentals. You can get by with 20% down, but the rates are and costs involved are a lot higher. So if they can do 25% down, they're going to get much better rates and lower points that are going to need to be charged. Again, 620 credit score, that's a hard set rule for Fannie Freddie. And we'll talk about this a little bit more, but there's 3 credit bureaus, as you're probably aware, and then we use the middle score of those 3 for that borrower to decide what that 620 score is. 50% ratio is the max for Fannie Freddie. Gift funds again are allowed. Co-signers can be used for Fannie Freddie with 5% down, and for owner occupied only. I talked about the interest rates obviously varying with credit scores, and Fannie Freddie is better for higher credit score borrowers. So.
All right, second part of loan product details. So VA, jump back to VA and a little bit more into that. Eligible to veterans only. Owner occupied. No down payment to a VA loan. So there's no down payment required from the VA or for the VA loan, which is obviously a huge benefit. And no mortgage insurance. That makes a pretty big difference in cost, in monthly cost of loan.
VA loans are probably the best loans that are out there, honestly, if it's eligible for it. I'm closing one on Friday. The borrowers are getting money back at closing because they put certain amount down for earnest money. They put no down payment, got some seller concessions involved, and they're getting money back at closing. So it's a phenomenal.
Yeah, I've had that happen a couple of times before as well. They're shocked.
Yeah.
They didn't think it was gonna work out like that. But, yeah, they get into their first house or their second house, depending. Get money back. Lower interest rate than Fannie Mae, Freddie Mac, and lower credit scores allowed. So you think conforming loans, again, that's Fannie and Freddie. The credit scores don't have to be the 620 to get into a VA loan.
Yeah, they'll go down to 600. Some investors will go lower, but 600, you can go down to 600 pretty easily with VA.
Yeah.
The rates are higher again versus a 640 or 660, but once you get over 660 on VA, it's basically the same rate up to whatever 800. So.
Best suited for first-time buyers, but VA eligibility can be used more than once. So, I don't know what you're saying. They can't use it again. There's a couple of changes to the loan with that, and you don't need to worry yourselves about that.
One of the caveats there, though, is they can't have 2 VA loans at once, or FHA loans for that matter. You can only get to basically sell this house that has a VA loan in order to buy the next one.
We refinanced our house in
Yeah.
Kansas City with our VA loan and then have the VA loan availability for out here.
Okay, yeah, that's
We
true,
use that
because you're a
house
certain
in Kansas
distance
City.
away from your other
Correct.
property. Yes, there are some exceptions to the rule, but in general, if someone's staying around here, they typically can't have 2 VA loans. If there's some divorce things going on, then there's some exceptions involved there too. But
Pretty flexible, much more flexible than the other programs. So again, that's why we're saying this. VA is pretty much probably the best loan out there. Funding fee is charged on VA loans, usually 2.3%. Now, if you use it again for a second time, so you sell the house that you had a VA loan on, buy another house with your VA eligibility, the 2.3 would increase a little bit.
it's up to 3.6 if they use it again, subsequent use. Yeah.
And so and is added onto the loan amount.
So yeah, so basically it gets added on. So if it's a $400,000 loan, 2.3% is like 10 grand, just over 10 grand. So the loan balance starts at 410,000, even though the purchase price was 400,000 on the house, but they're not paying it out of the pocket. It just gets rolled onto their loan amount to start out with.
Loan limits are allowed to exceed 715,000, still with 0% down.
VA jumbo loan, it's, I've done $1.5 million before, no down payment on a $1.5 million
Wow.
loan. Yeah,
Tremendous.
yeah, and the rates are a little bit higher in jumbo VA, but still not that much.
Yeah.
Not that much higher, so.
Renovation loan now available.
That's cool.
I've
Is
not
that like
done
a HELOC?
renovation loan through-
No, it's actually, so what they do is they have to get an appraisal done. Well, it's a little more complicated. It takes a little bit longer, just so you know, it's not a 30-day close, but you have to basically have a contractor come out and get an idea of what kind of scope of the renovation they want to do. An appraiser comes out and they says, based on the work that's going to be completed, this house is going to be worth 550 instead of 500 or whatever it is. Then we will let them borrow the $550,000 based on future plan, future work to be done on it. The money gets set aside for the construction side, the title company holds onto it, and then they'll pay it out as the work gets done. But it's a way for them to finance it all under one first mortgage.
What are the interest rates for a renovation loan?
They're gonna be higher still. I haven't looked at one in a long time. They are a little bit higher. And same with the Fannie Freddie. They also have a renovation program and those rates are a little bit higher than just a standard 30 years. Yeah, Bruce.
Did I miss it? So I know there's funding fees on these. When is the situation, one of the biggest questions that I get is, if I have a VA or FHA buyer, when is it mandatory that a seller pays for some of the fees? So
Well,
our contract changed last year. And it is tripping me up even, because I've always been told if I need a fee for this type of loan, I put it in seller concession. Now we have a separate spot that says buyer is grabbing an FHA or VA loan and seller is required to pay X amount of dollars.
Most of those have to do with title fees. They're called non-allowable fees for the buyer to pay for a VA loan. And then usually we just have the seller, try to have the seller pay those. Sometimes the lender actually, like we work with Rocket Mortgage, they will actually just pick up any kind of VA fees that aren't allowable to be paid by the buyer.
So maybe it's just been a matter of time, over these last like 5 years.
A lot of that's gone away. This last one I did, closing on Friday, that didn't even come up, the non-allowable fees.
Okay.
So I don't think it's as big of an issue as it used to be.
Okay.
Yeah, so.
Does the VA still have the debt ratio?
Yes and no, technically not really. They do it more so on the amount of residual income that's left after expenses, which is a different way of qualifying someone. So if you can get the software again to approve someone at a 65% debt ratio and it says approve, it'll take it and VA will do it. It's not easy to get those done, but it works better for folks that are like just make a bunch of money. And so let's say they're making $20,000, 50, whatever it is, a lot of money. So they're in 50% ratio means they've still got $10,000 of income to work with. If they make 20, that's a lot of residual income to pay some bills. And that's when VA will oftentimes go over that debt ratio allowability because they're making a lot of money. If someone's making $4,000, they've only got $2,000 of residual income, you're gonna have a lot more difficult time getting that software to approve that loan. But yes, you can go over 50% with VA. It happens pretty regularly.
Is that 715 number just for Colorado or is that a
That's-
national?
That's the new nationwide loan limit for conforming loans, standard true conforming loan limit. This year it's been 647,200. Chris mentioned before that was 547 and change. The year before that, it's been 47. It keeps going up every year, but this is the new limit, or the new, I should say it's the new estimated limit, because it hasn't officially been announced yet, but it's a pretty easy formula for the lenders to calculate what that limit's going to be. So they're allowing us to close loans now at 715 or below and still call it a conforming loan. So,
Question, how do rates vary for which state you live in?
they typically don't. They might a little bit, but it's usually not, doesn't factor into it too much.
Generally, rates, what they charge, what banks charge, or what you get in charge on your mortgage is associated with the risk involved. If you've got somebody with a lower credit score, just think higher rates. If you have somebody that's not making as much money as what they're putting out, that's a risk for the bank. If you're talking about a home that's over 715,000, on both sides, that's a risk for the bank. There's not that many people out there that can buy it if they were to turn around and try to get rid of it. So risk versus rate, or risk equals good rate. All right, so Chaffin, the Colorado Housing and Finance Authority. Personally, I have not done a chapter.
You want me? Okay, so I'll talk about it. Let me sheet here. So Fha Loans, it's a statewide program. they do have income limitations for borrowers. It's designed for first-time home buyers that have lower income. 148,120 is the new limit, or the limit this year, I should say. It might go up, probably will go up next year, since people's wages have been going up here. But it's designed for folks that just don't have the down payment, the 3% or the 3.5% to put down. Chaffa will give the borrower 4% contribution to help cover all the down payment, either the 3 or the 3.5%, and some of it will go towards closing costs as well. Chaffa loans are a little bit more expensive closing cost wise than FHA loans or Fannie loans for that matter. They're technically, they only require the client to come in with $1,000 of their own money. But if you're doing a Chaffa with no seller assistance, it's going to be more like probably $4,000 or $5,000 are going to need to have to cover the closing costs. These days, I said, 8 months ago, it was very difficult for the seller to get the seller to help cover the closing costs. But nowadays, it's a pretty easy ask, obviously, as we all know. So if you can get the seller to pitch in $5 grand towards closing costs on a Chaffa loan, as long as the borrower is coming in with $1,000 of their own money, then they'll be fine. Honestly, the biggest hurdle to a Chaffa loan is the earnest money, because you got to come up with probably 1%, right? So they have to have at least, $4,000, $3,000, $4,000, $5,000 in their pocket to have to come up just to start off with the earnest money to get under contract on something. So that's going to cover their $1,000 that they need into it. Gift funds again can be used on Chaffa loans. Chaffa does both FHA and Fannie Freddie. Technically, they do USDA and VA loans as Chaffa too. I honestly have never done Chaffa VA or Chaffa USDA loan. It's just, I don't really see the need for the Chaffa VA. Maybe they just need the money towards closing costs or something like that, because it's a no down payment loan. So as long as they have some money into it. But that's Chaffa. And then we're coming out with a new program. We actually have it available. I just need to do some research on it. It's called the Genoa Fund. And what they do is they'll do the 4% contribution, but it's a forgivable lien on the property over time. This Chaffa loan, I didn't mention that, but it's a second mortgage that gets filed on the property, a lien on the property. So when they go to sell it, there's going to be their first mortgage that they have and the second mortgage that they would get paid off, or if they're going to refinance it, both those loans need to get rolled into one loan in order to refinance it. But with this Genoa program, this 4% will be forgiven over a 36-month period. And so it's gonna, I don't know what the rates are yet. I got to do some checking into it, but that's something that we're going to be able to offer here pretty quick for down payment assistance as well. Let's see, next slide is talking about USDA. As Chris mentioned, this is for rural properties only, but it's a little misconstrued in the sense that there's a map that you can get online, a USDA property eligibility map, and it really has more to do with the population in certain areas. It's not, you can't do a loan, USDA loan in city Longmont proper, but you get just outside the county line, and then you can do a USDA loan, or even like in the mountains west of Boulder City, up in the Lyons is USDA eligible. So you can do it on just standard plain vanilla houses, as long as they're in the eligibility areas that are available for USDA. And so this is a no down payment loan as well. And there's mortgage insurance on this one, but it's less expensive mortgage insurance. It's probably 40% of what FHA costs for mortgage insurance. I will say that there are some pretty serious limitations to this loan in this area, geographic area, just because the property values are so high that this 29% here, this debt ratio of 29%, that means that their mortgage payment has to be just about 30% of what their total income is. And that's difficult to do, and still stay under the income limitations that are required for USDA.
No, that's if they have no other payments, right?
That's just their mortgage. So they have to, even if they have, they can have
So
car
30%.
payment and student loans. They can go up to 45% or 50% debt ratio, but they have to keep their mortgage payment at 30%. And that's just difficult to do in this area with values where they're at. But we certainly like to, present it to people if it fits all the buckets as far as being eligible for a geographic area and their income is such to be able to make it work. So, portfolio loans, I'll just breeze through these relatively quick. Asset depletion loans. So, as people know, you have to have income to be able to qualify for a traditional loan. But if this is a situation where let's say someone's just got $3 million in the bank, but they're not working, so there's nothing on tax returns to show income for qualifying, but we can calculate income based off of their $3 million that they have, whatever the number is, million or something, and then be able to qualify them based off of the assets that they have, not just the income that's coming in. Credit scores as low as 600 is interest-only loans. Those are more for jumbo financing. Fannie, Freddie's, NFHA, VA, all of the other ones don't do interest-only, but jumbo loans will allow for interest-only loans, so we can do those. DSCR loans is something that's come online here in the last year or two. These are for rental property purchases only, investment properties only. This one does not qualify based on traditional income either. They only qualify based on the income that's coming in from that particular property they want to buy. The rates are going to be higher on these, but this is a good program for investors, especially if someone doesn't have a lot of income on tax returns that we typically need to see for qualifying. These DSCR loans are nice options. And then reverse mortgages, I just stuck it under portfolio. It's not really a portfolio loan. The reverse mortgages are FHA government-backed loans. It's probably the most highly regulated loan that's out there. Reverse mortgages are for age-eligible seniors. And so you have to be 62 and up to do a reverse mortgage. Reverse mortgages can be done for both purchases and refis. The main premise behind a reverse mortgage is there's no mortgage payment that's involved with a reverse mortgage. You just have to have a lot of equity in the property to make the reverse work. Usually it's at least 50% equity in the property to work. But this is a great program. It's not for everyone, but it's a great loan for the right borrower. So if you have someone who's, we're seeing a lot of it in people that have been living on their houses for 30 years and they're retired and they have all this equity in their house that they might not have planned properly for retirement, so they don't have a lot of money to live on. Well, this allows them to live off the equity in their house and use that in retirement. So it's a great program for the right borrower again. Jumbo loans, just real quick, again, loan amount 715 or greater. Typically you have to have, well, you do have to have more down payment, at least a 5% down payment. 10% down loans are available as well. The rates are a little bit better, but really the rates don't start coming into line, in my opinion, until you have at least 15% down to 20% down for a jumbo loan. And as I mentioned earlier in the meeting today, the jumbo loan rates right now, it's a little odd, but they're actually better and lower than conforming rates are. For the right borrower, it's, again, credit score driven, down payment driven, things like that. And these can be used for owner occupied second homes or rental properties. There's a larger down payment that's required for rental properties and for second homes. And then the credit score requirements are a little bit higher as well, typically 680 and up. And I have here break for drawing. So we're going to do a drawing here, and we'll do 3 of these along the way. So I'll let Chris talk a little bit about it.
All right, so everybody online with us as well, that's in class here with us. We've got names in a jar over here in the corner. I'm going to pull one of those names and give you one of these. Now we're going to have 3 of these breaks. Thank you, Chris. We're going to have 3 of these breaks. So this is the first. There's 2 more to come. Stay tuned.
Drum roll, please. You get to see much.
Hello, this is Liz. How can I help you?
Is the suspense killing you?
Hello.
Hi.
No, she's not on mute. She just picked up a call.
Oh.
Leslie Shedd.
That's her.
What was it?
I recognize the voice.
Hi.
Hi, Leslie.
Hi.
Are you on another line? You want us to hold?
No, that was Liz.
Okay, all
I was
right.
gonna say after that.
All right, so what we have is real estate photography. So this is a voucher for a free virtual home tour
Oh, wow.
and free, still photographs of the, real estate photographs. So,
And I looked at it. It's not just like $50 off. It's like the package.
yeah, you get it all.
He
Yeah.
wants one.
Cool.
So Leslie, we got this up here for you.
Wonderful. That's amazing. Thank you.
If you're here in the next 10 minutes, you can have it. Otherwise,
Well, then you might give it to somebody. I'm in Houston.
I'm kidding.
She's listening in from Houston. That's awesome.
Nice.
All right, so we're at types of borrowers. So there's 3 different types of borrowers that are under yours.
Oops.
Now, you guys are probably familiar with all of them. Some of the folks will not be, or at least how you signify what they are. You have the happy buyers, you have the not happy buyers. No, I'm kidding. So you've got owner occupied. So owner occupied obviously means that the person that's buying the house is going to live in the home. So plan on living in the home they're buying. Can be multi-unit properties up to 4 units, which is interesting, right? You can still call one of those 4 units home, and the other 3 do with what you want, right?
And as you rent those out, you can actually use the income from those 3 other properties to help qualify you to buy that property.
Right. All right, so the other is second home purchase. So this is a pretty happy buyer. Currently own a home or rent and want to buy a property for use as a destination. So most commonly a vacation type home, which is probably how the VA signified or defined your second property. Home purchased typically needs to be at least 50 miles from where they reside. And typically needs to be in a destination type area. So that would be a second home. If you're trying to call the house next door to you, your second home, yeah. Now, we've seen that trick before. So yeah, it comes with some rules, and the rules are at least 50. It has to be at least 50 miles away from your current residence, your primary residence.
And that's kind of the guideline that underwriters look at. I mean, you could buy a house in Estes Park as your second home, even if you live in Loveland, you know, so there's sort of make sense rules to that, but in general, they like to say that it's, you know, over a commutable distance, based more than what a commutable distance might be, you know, that's how they kind of determine it. But if it's a makes sense in a second home resort type of area.
So in Florida, for instance, and I can speak to this, is people would own a house that's not on the beach. And then they would buy a condo as a second home that's only 10 miles away. And that could be a second home. I mean, that made sense, right? I mean, you got a place to go to on the weekends instead of the beach. Kind of the same thing here. You live close to Vail, you want to buy a place in Vail on the slopes, it makes sense. It's a second home. Investment properties. Buying property with the intention of deriving income on that property. Can be 1-unit houses or condos or multi-unit properties up to 4 units. Over 4 units is considered a commercial property. That's not what we do. We do residential lending, commercial loans, that's somebody else. Not another mortgage lender like us, but it would probably be a banking institution, is where they would go. Higher rates and larger down payments are required on 2 to 4 unit properties. Up to 10 finance properties are allowed for Fannie Mae loans. So for investment properties, Fannie Mae says you're capped at 10. It's going to be too much risk. When you think about it, you know, one bad year, they get rid of one property, they've got to start getting rid of the rest of the properties. It's risk, right? So they call their risk limit a 10 finance properties. Portfolio investors are allowed unlimited finance properties. So again, kind of outside the box portfolio. So that's what we're saying.
The portfolio rates are going to be higher. I mean, again, same thing, more risky, higher rates. And the important distinction there is finance properties. So if someone owns 10 free and clear properties, that doesn't, they haven't even checked number 1 yet. It's only for financed properties is where that rule comes into play. And that rule has, and it's been that way for quite a while. Actually, during the Great Recession, that got knocked down to only 4 finance properties available because of the risk that was involved. It's gradually made its way back up to 10 finance properties. And then types of loans that we're seeing right now, most common, obviously 30-year fixed rates. That's the most popular loan because it keeps the payment down, obviously, but 20-year loans are available, 20-year fixed rates. The rates are going to be slightly lower on 20-year, and then 15-year lower still. Right now, it's about 0.75% lower in rate for 15 versus 30. I'm not doing many 15s right now because the payments are high enough on 30. So 15 years are kind of out of the, not going on right now. But if someone needs it, they're available. And then ARMs, adjustable rate mortgages, 5, 7, 10 years are usually the typical terms on those. One of our investors, just as of yesterday, started coming out with some, what I would call decent 7-year ARM pricing. It's about 0.25% to 0.5% lower in rate than the 30-year fixed rates. So we'll start promoting that a little bit more for the right borrower. We're seeing, overall, I think about 7% of the mortgages that are being done right now are ARMs, and that's just solely because rates are so high that you can get into potentially a lower rate with an ARM. Obviously, there's more risk involved as far as it's going to start adjusting on you after 7 years if you're still in that loan. Chances are, though, with rates as high as they are, I'm hoping people will be able to refinance in the next year, 2, 3 at tops and be able to get out of that 7-year ARM and into something 30-year fixed. But that's why they're becoming more popular, just because they're slightly lower in rate.
And you probably already said this, but the rates are a little higher by an hour, right?
They were for a while there. Now, there's some banks out there that are offering better rates, slightly better rates on ARMs versus 30-year, primarily because they're portfolioing those loans. But now, finally, some of our investors that we're working with are coming around to where their ARM rates are actually lower.
Oh,
than
okay.
30-year. Yeah.
Okay.
Yeah. I mean, makes no sense to do a 7-year ARM if the rate's higher than a 30-year. So I haven't even been talking about that much. But now that they're
Mhm, now that
slightly
they're-
better,
wow.
we'll start talking a little bit more about it.
Okay.
All right, so mortgage payment components and debt ratios.
Oops.
I'll get that on the screen. Thank you, Grant. So mortgage payment consists of principal and interest payments. Principal meaning that it goes right towards the loan amount. It comes off of the loan directly. And everybody knows what an interest payment is. That covers the rest. The cost of the loan. And also monthly prorations for property tax and homeowners insurance, called PITI. So mortgage payment covers your principal and your interest. And then you've got your taxes and insurance that's escrowed into it. They call that PITI. Okay. And that's what we're going to judge the house cost for the buyer on. Okay. So we're going to use that total figure, principal, interest, taxes, and insurance. And if there's mortgage insurance involved, we would use that as well to calculate the overall debt ratio. There can also be monthly mortgage insurance. That's part of the payment, if less than 20% is put down. Homeowners association dues also need to be factored into the debt ratios. So you're in a development, you've got a $400 a month homeowner association due. We're going to take the principal, interest, taxes, and insurance, the mortgage payment, plus the homeowners insurance. I'm sorry, plus the homeowners association cost. And we're going to factor that into the overall cost of housing. These pieces are what comprise the mortgage debt to income ratio, also called their front end ratio. Total debt to income ratio, referred to as their back end ratio, typically can't exceed 50% for Fannie Mae, Freddie Mac loans. All right, so front end means just the house payment with taxes and insurance, homeowner association, those sort of things. And then back end is all the rest of the debts added to that. So car payments, credit cards, student loans, that sort of thing. Up to 55%. So this is where FHA and CHAFA, they allow a higher debt to income ratio. Up to 55%. The automated underwriting system determines the allowable debt ratio for each borrower. So like computer software gets to choose. It's not always cut and dry. We can't say definitively it's going to be exactly 55%. You're good. Once we run it through the automated underwriting system, and it says, we're not good with that, That's what we have to go.
Yeah, it's not a given to get to 55. I've had some FHA loans where I couldn't get it done at a 42% back end ratio, and it's supposed to be more lenient, so it just really depends on the overall layers of risk, like Chris was talking about, maybe how much money they have in reserves over and above the down payment. That's a good it's called a compensating factor to help get a higher debt ratio approved. But it's, it's just kind of whatever the software says is what we typically can do. So, and then Chris talked about the total debt ratio, the back end ratio. That's going to include car loans, car leases, student loan payments, minimum payments on credit cards is involved with that. Alimony, child support, things like that are all being written into there or included in their total debt ratio. Student loans, I'll just talk about that briefly. I'm not sure if there's anything in, I can't remember if it's something about here in more detail later, but while I'm thinking about it, with all the deferment that's been going on with student loans lately, people don't think we have to use the $100,000 of student loan debt that they've got because they're not making a payment on it. But we do have to factor in some sort of a payment on that. Usually it's about 0.5% of the balance of the loans, and that's the number that we use to qualify them. FHA used to be 1%. They recently took it down to 0.5%. So if it's $100,000 in student loans, we're going to hit them with $500 a month for a qualifying payment on that. Freddie Mac also allows 0.5%, but Fannie Mae is still stuck at 1% for some reason. So if people have a lot of student loans, we're probably not going to go Fannie. And we can also use what are called income-based repayments, so income-based student loan payments. So once they come out of deferment, which I think is now supposed to be December, then if they can get something in writing saying your payment's going to be fixed at this amount based on your income, and it's $25 a month. I mean, I've seen some where they have a huge amount of debt and they're only paying $25, $50 a month, but then we can use that as their qualifying payment if we get it in writing that it's an income-based payment. So, yeah.
Supporting documentation.
Yeah. Let's see. So what else do I have here? So the debts raised don't include things like utilities, phone bills, car insurance payments, daily living expenses, things like that. And then we talked about the VA. This excludes VA because VA does factor some of that stuff into their overall qualifying payment as far as utility costs and things like that. But we don't, anything basically that doesn't show up on the credit report, then we don't count it in their qualifying ratios. So.
All right, mortgage insurance. Everybody loves mortgage. Not really, right? But it is insurance, and it's insurance that covers the bank. Doesn't cover the borrower. But it does allow the borrower to finance much more money than the 20% down that they need prior to mortgage insurance being brought up. Okay?
It protects against foreclosure. It's protecting the lender against foreclosure. That's what the mortgage insurance is. And actually the rates are slightly better when people do have mortgage insurance because they have that less risk involved because of the foreclosure insurance that they're paying.
A little bit more secure that they'll be able to get cash out of that sad situation. Okay? Typically required when there is less than 20% down or equity in or 20% equities in the property. It can be paid monthly in a lump sum or be built into the interest rate. So a couple of different ways to go about mortgage insurance. If it's made along with the mortgage payment, it's just an added cost. You have a going rate, okay? If you build it into the interest rate, this is a little much, but put it into the interest rate. So you're gonna pay a higher interest rate instead of paying the monthly mortgage insurance. If you're self-employed, or you write off the interest on your taxes that you pay for that mortgage, you're gonna have a bigger write-off, right?
Versus if it's monthly, you have to be under a certain level of income to write off monthly mortgage insurance. I think it's like $110,000. So if you're over that, you can't deduct the mortgage insurance you pay monthly. But if you're paying 7 1/8 versus 6 3/4, then that additional interest that you're paying increases the amount of interest deduction you have for tax purposes. And it's irregardless of how much money you make. So.
So again, we might be getting more than what you really need to know, but
Yeah.
there are advantages. So if you see that, send a loan to Grant and it was 6.875, and then you send a loan over to me, and I'm saying, 7.125 is a great rate. Like, you need to know the whole picture, right? I mean, it's not just cut and dry. So,
And I think you mentioned it can be paid in a lump sum too, so that's a good thing to use if you've got some seller concessions you need to eat up. You can, if it's $3,000 to do a one-time mortgage insurance premium versus $75 a month, that $3,000 can be paid by the seller. So it's another way to eat up some concessions if you need to.
what about Chapel?
Chaffa, it would just, yeah, you could do that, because if it was a Fannie Freddie loan,
Right.
you can also have the seller can pay there's an upfront mortgage insurance premium for FHA that gets financed into your loan amount, 1.75%, and you can have the seller pay that full 1.75% as well. They have to do it all or nothing. You can't pay a portion of that. It's either all or nothing.
So there's a few different ways that you can spend one borrower, depending on what their needs are, and is the best loan for them. Or you could just give them the lowest rate. Lowest rate isn't always best for the borrower. But that's what everybody thinks, right? So, and that's the reason that we're kind of doing this, is so that you guys are educated on it as well. You know, you talk to your neighbor and they're going through a different realtor or a different agent. And they say, wow, look, my buyer's getting, 6 when I go through my guy. And then you're like, well, yeah, he's getting 7 through my guy. Well, you don't know the whole picture. So there are some factors that bring it into that. Okay? So FHA loans have the highest cost mortgage insurance. They charge both an upfront mortgage insurance premium, that was the 1.75, which is built into the loan amount borrowed, and a monthly mortgage insurance cost as well, which is part of your monthly payment. So that's just added in the monthly mortgage. As mentioned earlier, the monthly mortgage insurance does not drop off at this time. So many people will refinance into a conventional loan out of a FHA loan to reduce or eliminate the mortgage insurance cost. Even if the rate is the same or even a little bit higher, they benefit from it. So FHA does not fall off. The mortgage insurance does not drop like on a conventional loan. Okay? On a conventional loan, once you get down to below 80%, 79.9% loan to value, the value of your home is now increased, your loan amount is decreased. With a conventional loan, you can apply to have your mortgage insurance.
I have a question.
Yeah.
Concerning the FHA, a lender told me about a new program, I forgot what the name of the program is. But you can get an FHA loan, and in 6 months, as long as you make your payments on time, you could refinance. And it's easier than a normal refinance, but it's easier, but they can refinance to a conventional. Is that, do you guys know anything about
Well,
that
I mean,
procedure?
it's just, it sounds to me, it would just be like a
Right.
standard refinance, because it's two different, FHA and conventional loans are two different
Mhm.
animals. But what they're probably doing is just telling people, do the FHA loan now, and in 6 months, we can look at doing a conventional loan, refinance you to get you either out of the mortgage
To
insurance.
get out of the mortgage insurance, that's what they're.
Yeah, but I mean, 6 months isn't enough time to,
Yeah, 6 months probably wouldn't allow for enough time. Now, what I do know,
It's-
this is from my past companies that I've worked with. If they refinance or sell the house within 6 months, the account executive or loan originator
Well,
has to give back their commission.
yeah,
Yeah.
yeah.
that's why
I
they
do
say
know
6
that.
months, because we're.
But it's through, it was Kansas, and it was through Keller Williams. It was through their mortgage company, but he told me that, when the people bought in Kansas. But
Yeah, I
I
mean-
forgot what the name of the program was. He said it just.
Yeah,
came
I haven't
out.
heard of that if there is a program. I'm not saying there isn't, but I haven't heard of it. From what it sounds like to me is they're just offering them the ability to refinance into a conventional loan out of FHA after that 6-month period, so that our income doesn't get impacted.
Right.
And,
Right. So you wouldn't lose your commission For the, or
Less
you
than
would?
6 months.
If that loan gets paid
6
off
months.
6 months prior to us selling the loan or closing the loan, it's easier to think about what. the
Oh,
loan
well, yeah,
closes.
6 months prior.
Then we have to, it's called an early payoff fee that the lenders get
Right.
hit with, and we have to give our total company revenue back to that lender we sold the loan
Right.
to if it gets paid off in 6 months or sooner than 6 months. Doesn't impact your borrower at all. There's no prepayment penalties on any of these loans we're talking about, no prepayment penalties. So they could turn around if they had to sell the house in 2 months, and that's just the way it is. They're not gonna get dinged with it at all. It's just the lender does if it's
It's just
before
the
6
lender
months.
does.
Yeah, and there's a couple of different reasons for why he pitched that like that. Possibility of the second loan, which is a slim possibility, being able to refinance into a conventional
This
loan with no
quickly.
mortgage insurance.
Yeah.
But to sell the FHA, borrower got a higher rate than what they were hoping for. He couldn't really justify it. It just is what it is. And that's what he told the buyer.
Told them, I'm gonna have to find out what the new.
But I'm glad you mentioned that, because what we are telling buyers right now is, we can refinance you when the time is right, if rates go down. And we can structure it to where we pay the closing costs on their behalf, or a good chunk of them. There's two different pieces of closing costs. There's the actual costs, which are title work, lender fees, appraisal. That's one section, part of closing costs. The other is your escrow accounts and insurance and all that. So we can cover the closing cost piece of it. We have to charge a little bit higher rate to do that, but it's in this, what we're hoping with this downward cycle that's going to be coming up here is people, they could refinance 2 or 3 times between 7% and 3.5% if we ever get down there again, and they don't want to pay costs every time. I would rather pay the cost for them, have them take a 0.25% higher in rate and refinance them at 5, and then pay their costs to let them maybe do it again, that down, and then when they get down to that lower level, then they can pay their own costs and get the absolute lowest rate.
Okay.
But we're gonna, we.
Are you
lenders
seeing
have done
that more?
Yeah, well, that's what we're hoping to see.
I know.
If rates come down here,
You know,
so,
but makes sense.
Eventually.
yeah, exactly. But I'm telling people a year or 2. Because, house, first of all, the house has to appreciate enough to be able to get the mortgage insurance drop if they only put 3% down. In this market, that's gonna take at least a couple of years, maybe longer, but, really, the big thing with FHA too is they gotta get their credit scores up, because they don't want to refinance. If they're still sitting at 660 2 years from now, their rates are gonna be quite a bit higher in that conforming loan. If they're still paying mortgage insurance, they don't have the equity to drop it, they're gonna be paying a higher cost of mortgage insurance. So it's really getting them to get their credit scores up at the same time as having the rates come down. So this is next slide. Yeah, this is Fannie Freddie. So this is what's called private mortgage insurance. This is not an FHA loan. And so these costs do vary pretty significantly, as I was just talking about, based on credit score. The higher the score, the lower the cost is for their mortgage insurance. And also the more equity they have in the property, the lower the cost is. So with Fannie Freddie, there's different tiers of mortgage insurance. There's 5% down, 10% down, 15% down, 20% down. There's no mortgage insurance at all. But the mortgage insurance cost decreases as their down payment increases. And again, it's lower cost with the higher credit scores. And so we talked a little bit about the mortgage insurance can be rolled in, it can be paid monthly, it can be paid as a lump sum closing, or rolled into the interest rate. And then Chris mentioned the 79.9%. And so I have down here 78%. The mortgage insurance is going to drop off automatically with the Fannie Freddie loans once the loan's been paid down to 78% of the purchase price. So if they get down below 79.9%, then you can petition to get it waived by getting an appraisal to get the mortgage insurance.
Except for FHA. FHA is lifetime, right?
But FHA is going to be there for the life of the loan. Yeah, yeah. And Jake just came in just in time for our second drawing.
Yes. Timed it perfectly.
So go ahead. Drawing.
This time, you're gonna be washing my truck.
Came in at the wrong time. Gotta step out.
Oh, you should have seen the other one. Hey, look.
Caleb, all right.
You gotta watch his trash.
Go Caleb. You're worse than his crap.
What?
You got it, man. Yeah, sure. So Jake, what we're doing is a giveaway, 3 different times. So you missed the first one. Could have been.
That's fine.
Could have, would have,
You
should
missed it.
have.
And what it is real estate photography. So a session of still photos. And then the virtual tour as well. So for all of it, absolutely no cost. whatsoever. Okay?
Just in time for this maybe listing. Vietnamese.
Augustine, did you get your name in?
I did, yeah.
Okay, good.
All right, closing costs. A lot of people are unfamiliar, a lot of buyers are unfamiliar with this. Most of you are familiar with closing costs and what's involved. In addition to down payment requirements, the borrower will incur closing costs when buying or refinancing a property. There are various ways of paying for these costs. Costs typically start at $7,000 to $8,000.
And that's all in as far as, I was talking about the two different buckets of closing costs. Usually it's gonna be like $3,500 for the lender piece of it, you know, the title work, the appraisal, the lender fees, all that. And then another $3,000 to $4,000. The way insurance costs are these days, you're gonna pay that much for paying a homeowner's insurance premium at closing and setting up the new escrow account for the new loan. So, you know, and then if it's $1 million property, it's gonna be, you know, more like $10,000 to $12,000 in closing costs. So the higher the value of the property, the more the closing costs are gonna be. So, but people just don't think about, they think, well, all I need is 5% down. Well, you're gonna be, you know, 5% down, $500,000, $25,000 plus $7,000 or $8,000, you know, on top of that. So.
These costs are typically paid by the borrower in addition to the down payment. Money for these costs can be gifted in addition to the down payment. So if the borrower, first-time home buyer, they don't have the money to stretch out to do the down payment and the closing costs, mom and dad are, you know, they set a little something aside for them to help getting him out of their house. It can be a gift. You know, there has to be a letter that's written by them, signed by them. And we have to be able to track that money where it came from. But bottom line is the additional cost over and above down payment can be a gift from a relative or an employer.
Yeah, you can do an employer one, yeah.
Seller can be asked to pay the borrower's closing costs either as part of the initial contract or as part of the inspection process. See the next slide for details.
I'll show that next slide and see if we're done with this one.
Lender can also pay the borrower's closing costs by increasing the interest rate to cover some or all of the costs. And Grant was just talking about that. Borrower comes back in, he got a high rate because of the circumstances at that time. A year later, 2 years later, he wants to refinance, his rates are better. Inflation, his property value may have gone up, so he'll get a better rate if he refinances. What we'll do is pay their closing costs for them. And we're not coming out of our pocket for it. We're not that giving. I mean, we like helping people, but
Well, they pay for it. If it's 1/4% higher in rate, their payment might be $75 more a month, but at least they didn't pay $5,000 in closing costs to do it. So if they can refinance it again in that 5-year period of time, it was better for us to pay the cost for them and them just to pay $75 more or whatever it is. A month. So.
points can be paid by the borrower or the seller to pay a lower interest rate on their loan. So they can buy down the rate. Okay? This can make sense if the borrower plans on living in the house for a long time. And current high interest rates are.
Only for the seller. I wouldn't want the buyer to pay points right now, at rates where they're at, because hopefully they're gonna refinance in a couple of years. You know, and then, so it doesn't make sense for the buyer to pay a bunch of points, but if the seller can pay it as a concession, doesn't cost the buyer anything, you might as well take that to buy that rate down and get that payment lower right now. So.
What does a point equal?
It's 1% of the loan amount. And so we're gonna talk next about seller concessions. Seller concessions are based on the price of the house. So here, let's go to the next slide. But points are based on the size of the loan. So if you've got a $500,000 house, 3% concession in this case on that top one there, that's $15,000 that the seller can give the buyer towards closing costs and prepaids. If it's a $400,000 loan, one point is $4,000. So it doesn't cost as much in points as you get in concessions to pay that down. So this is basically the guidelines for Fannie Freddie as far as concessions are concerned. So 3% max, again, like based on the purchase price, up when it's 10% down or less. They'll do a 6% concession if it's 25% to 10% or 10.01% down. You can get a 6% concession, and then a 9% concession if it's 25% down or more. That's a pretty hefty number, 10%, 9% concession, but it's allowable if the seller is willing to do that. Today's sales meeting brought up a good point as far as concessions with inspection items that come up. So I just recently had a deal where we got a 3% seller concession, the max that's allowed on this type of thing. Well, then all of a sudden, some inspection items came up and there was no more, they couldn't give them any more credit because they already gave them the 3%. So just keep that in mind when you're looking at houses. If you think the house isn't going to inspect well, or there's going to be some issues and they're going to come back with some dollar amounts that you're going to try to get there, maybe you just ask them for a 2% concession with a $5,000 price reduction up front. That way they're taking advantage of the full 3% of a $500,000 example, but then they've got 1% cushion there to eat up any concessions that come up from inspection. So just keep that in mind. This is an important point. So 2% max concession on rental properties. So that the 3, 6, and 9% don't apply when it's a rental property that they're buying. 2% is the max. FHA allows up to 6% and VA 4%. So we talked about it's based on the price of the house.
DSCR off the top of your head, if that has a max concession?
I do not know. I haven't found about concessions on DSCR. We talked about DSCR loans. That's the rental property loan where you can buy the property based on the income from that property specifically. It has nothing to do with the income from the buyer themselves. But I don't know. I can find out, see what the concessions are.
Off the top of your head, and if it was the same as that 2%.
Those are, like I said, those are somewhat new. The DSCR loans, I've done a couple of them, and neither one of them had any kind of concessions involved. So I'm not sure. So.
Grant, this is Leslie. I
Hi.
have before we get too far, I have a question going back to the PMI. Can a homeowner have their own appraisal done and qualify for the removal of the PMI, or does the lender hire the appraiser? What
That's
is
a
that
good-
process?
You definitely want to have your borrower or your client call the servicer of the loan to find out and ask that specific question, because most of the time they say, fine, get your own appraisal done and then give it, and then we'll base it off of that. But if they have a policy where they have to order the appraisal, then you don't want to order your own appraisal, you're just wasting money. So and so definitely have them just call the servicer and see what their policy is. I'm glad you mentioned that too, because the other piece of that is oftentimes they will not allow that to happen until they've owned the property for 2 years. So, so that it's just one of the mortgage insurance rules. Some of the mortgage insurance companies won't waive the mortgage insurance until it's been after 2 years, unless they paid the loan down. That's the only time they will typically waive it in a less than a 2-year period. So.
Okay, thank you.
You're welcome. All right, the loan process. So really, this is how we become involved with you guys and the buyer. So pre-approval letters are crucial for you guys. That's where we get brought into the picture to put the pre-approval together. So in the pre-approval process, the buyer is the first step in the loan process. Pre-approving the buyer is the first step in the loan process. Credit is pulled, income streams and down payment money is verified by collecting pay stubs, W-2s, bank statements, tax returns, if applicable. At this point, the loan can be run through the automated underwriting system for pre-approval. So we get their proof of income, the proof of assets with assets meaning bank statements, 401k accounts, whatever they can use for down payment, and W-2s to show that they've been making this money for some time. And we take an average over 24 months, essentially, is what we do. And we call that their income.
And that depends too on whether they're salaried or hourly. For hourly employee, then we are averaging it. But if it's a salaried employee, we're just taking whatever they're making right now. So that helps for qualifying purposes.
The qualifying process determines how much the borrower can afford. So this is where you get the number of what we're going to be shopping for. Obviously, we can, at times, say we could get this guy approved for 800,000. He's not ready to spend anything over 6. Well, we'll show you that he can get up to 8,000 or 800,000. And whenever you approach the sellers are going to want, or the seller's agent is going to want to see a pre-approval letter, right? You don't want to say that they're pre-approved up to 800,000. He's going to make an offer of 550. That's where we come back in and draw the new pre-approval letter.
Yeah.
I was saying you do the
Oh, yeah,
same.
yeah, we want to tailor the letter to whatever you guys are offering, obviously, and the letters that we have, it's just a Word document, so we'll have a good conversation with you and say, this is the max they can go to. So I'm gonna send you this letter. You guys can modify it if you need to, like if you're out on a Saturday afternoon and you can't get either one of us. The letters are modifiable to whatever you guys are gonna be offering within reason, So, for example, we want to have that conversation, say this is the absolute max they can do. And obviously, things like taxes and insurance factor into that too, whether it's a metro tax district or not. And that's a huge difference on what they can qualify for. So it really is property specific on what they'll be able to do. But oftentimes, like Chris said, people can qualify for more than what they actually are comfortable taking on, or at least that was the case 8 months ago when rates were at 3. Now with rates at 6.5, the payments are obviously coming up for folks. But in general, yeah, we'll just tailor the letter to whatever.
And when we send you that pre-approval letter in a Word document, don't move the numbers up.
Well, you can. I mean, I'm okay with you doing it as long as we've had that conversation that they are allowed to do it,
All of a sudden, $2 million.
Yeah. He really wants that $2 million house.
Only 800,000. All right. So do this qualifying process determines how much the borrower can afford or how much they want to afford. Oftentimes, on paper, buyer can afford more than what they're comfortable to borrow if they don't have a lot of other obligations. All right, so that's what I was just saying. Once the borrower is under contract, the application gets sent for signature. So once it becomes under contract, we start the ball rolling, okay?
Our application doesn't technically start until there's an address involved. And so on our pre-approval letters, actually, by the way, we don't put an address on there because once we do, technically, we're supposed to be able to start that application. So we try to avoid anything with the address on there until the contract's been signed. And then that's when our application date starts. So if you guys put in your contracts, application completed, technically, it's not really the case because from our perspective, our application hasn't started until that contract is signed and really until you get us the contract. So if it's on a Friday afternoon and you send it to us on Monday, that's our application date is the Monday, whenever we receive the contract is how we'd like to structure that. Because we have to get disclosures out within 3 days of them going under contract or the application started. And so that's, the clock starts ticking for that 3 days as soon as we know what the address is.
Well, it's under the application. Once the application started and you make it a
Right.
formal application, you have to have an address.
3 days out. So that's why we try to hold off until we know what the address is, because we as lenders, we want to have as much time in the 3 days as.
This is
as we're allowed.
compliance and this could sink us in our position.
Yeah.
Right?
Yeah.
Once the borrower is under contract, the application is sent for signature. This gets completed within 3 days of receiving the contract. We start processing loan by submitting the income and asset documentation, W-2s, pay stubs, or for non-self-employed borrowers, tax returns if they are self-employed or retired, or have rental property. 2 months worth of bank statements, brokerage accounts, statements are needed. All pages of the statements are required. It was kind of deep. When we start processing the loan, as soon as we get that in, asset documentation, again, it will be the bank statements, it would be the brokerage account statements. Wherever their assets are stored. And the more assets we show, the better for the borrower. Okay. So again, that's the conversation you're not going to be having with the buyer, but that's what we're going to be having a conversation with them about. Okay, so if they come up and say, hey, he wants my bank statements, I don't feel comfortable with it. Well, that's part of the process, okay? It's necessary.
So we try to ease them into this basically by starting the conversation as a pre-qual conversation. We can talk, you can tell me how much you make, and if you're salaried, that makes it easier from our perspective. If you're hourly, you've got to dig into, again, are you working full-time? Are you making this much an hour now, but last year you were making this much an hour? So I don't want to overcomplicate things when I'm talking to someone, but basically I'll just say, we try to say, how much do you make? How much do you have for down payment? We're gonna need this documentation to get any kind of a lender letter together. So if you want to make an offer on something, you're gonna need a pre-approval letter. Right now, consider yourself pre-qualified based on what we talked about verbally. But we have to pull their credit before, we can do any kind of a letter. People, there's surprises that come up people's credit. They just don't know that something's there. Most oftentimes it's collections that are on there. They have no idea there's a collection on there. And collections can pull people's credit scores down like 100 points or more. Just one $50 collection, your score drops from 780 to 680, and people just don't realize that. So that's part of the pre-qual process, and then the pre-approval process against getting the credit check. They can apply online to our websites, and that's 95% of the way my applications come in. Now we're all online. People said that they like that for whatever reason. They can do it on their own time. And it's easier for us because they're putting the information in. All we got to do is look at it once it's in there, and then
Sometimes
pull
it's
the
kind of
credit.
hard for somebody to talk to somebody else, a stranger especially, and say, yeah, I've got this, and later on my credit, there was this little flaw, it was all because of my ex, whatever. So in talking to somebody, online is easier a lot of times.
Most people tend to know what their credit's like, you say, if you hear someone say, oh yeah, my scores are 780 plus, well, chances are that's probably pretty accurate within like 30 points one way or the other. But if people start hemming and hawing about, yeah, well, this happened and that happened, that's when you really want to get the credit check to see what we're dealing with there before things get too far down the line. So
Credit check is necessary.
Yeah.
All right, so we try to have these conversations with what we are going to be asking for, not necessarily looking for them right now, but hey, later on in this process, when you made an offer, we're going to be looking for these documentations. And we're going to be calling your work to verify that you do actually work there still. You didn't quit last week, for example.
we do that twice, by the way. We do the verification at the beginning to make sure that what they told us income wise is what shows on the pay stubs, all that matches up. And then we call within a week prior to closing to make sure that they're still working there. So,
That just happened like 10 years ago or so.
yeah.
There was a lot of the made up pay stubs.
Handwritten W-2s.
That was bad during,
Yeah.
not the handwritten, but
That was-
calling 2 days before closing, that was bad during COVID.
Yeah, absolutely. Yeah.
So we need to contact employers to verify employment. We need to verify tax returns with the IRS. Collect info for homeowners insurance, give the condo project information if applicable, and make sure project is approvable. It's called warrantable. So condos are a little bit different. The bank wants to know if there's a certain percentage of non-owner occupied, like these are all rentals. You're buying your primary residence right here. We're not good with that, We're gonna make you put 20% down. This is a rental property, obviously. Suspected.
And so when it's a condo, there's two different approvals. You got to get the borrower approved, and you also have to get the condo project approved. And like Chris was saying, warrantability is important. We look at there's a few different main points to that. Owner occupancy percentage is one of the primary ones. If someone is buying it as owner occupied and it's a high concentration of rentals, they can still buy it as owner occupied. There's just getting a little bit more scrutiny involved to make sure that they don't have 5 other rental properties. Now they want to buy this one as their primary residence and it's worth less than the house that they live in, just things like that don't make sense. But if it's a makes sense first time home buyer purchase and they're buying, it's the only thing they can afford, that's going to work, and as long as it's owner occupied with 10% down, then we have what's called limited review, where we don't have to worry about the owner occupancy too much. They also look if there's any litigation going on with the homeowner association, that can be a deal breaker oftentimes. And then one of the things is how many units someone owns in a particular complex. So if someone owns 20% of the units in this 80 complex, 80, then that's a red flag. They just don't call that warrantable. They want to have it where it's less than 10% occupied, owned by any one entity. Those are the main things that make it warrantable.
So yeah, those are just, in regards to the condo, but really as far as the verifications, when we're contacting the employer, we're contacting the IRS to get verification that tax returns that were submitted are actually true and correct. That's where we're really tying things up, making sure there's no loose ends, make sure that we can get to closing on time.
And the timing on those transcripts could be an issue too, because oftentimes if someone just submits their tax returns on April 15th and we're closing April 18th, we're not gonna have time to get those transcripts back because it takes a couple of weeks sometimes to get
Everything pretty quickly.
coach people to where either move the closing date up to April 14th before it's required to have them filed, or that's the main thing we tell people to do. Or we just have to, sometimes we can catch the transcripts up after closing, but that can be kind of sketchy too sometimes. So yeah, it is a big ask. Yeah. All right. Okay. So then once all this information is gathered, we go into underwriting for approval. Underwriting these days is not taking that long. Literally it can be done in a day. It can be done in 6 hours sometimes if we have all the proper documentation to submit it. So, we wouldn't have the appraisal at that point. We get the credit and income piece of it approved first, and we order the appraisal. Appraisals, it says in here, give us a couple weeks. It's not taking that long right now. It's more like a week. We can even get it back in 4 or 5 days sometimes. So we're getting back to the situation where we can kind of hold off on ordering the appraisal until maybe the inspection is done and you guys know it's a viable property. We don't want to have them spend money on inspection and charge their credit card for the appraisal if it's going to fall apart on inspection. So just keep that in your dates. When you're writing these dates out, try to give yourself enough room between inspection and appraisal deadlines so that we can try to hold off on ordering the appraisal, especially if you think it's going to be kind of a questionable property condition wise. So and then the appraisal is a separate review process to get that approved. We order the appraisals, by the way. So if a borrower says, I've got an appraisal based on this for this particular reason, we can't use it as a lender. We have to order it. Reason being, it has to go through a round robin process where we can't choose which appraiser. We used to be able to choose which appraiser we wanted to use because we've had a 10-year, 20-year relationship with them. That went away probably 10 years ago or more as well. Now it's a round robin thing. We just have to put it in the system and it goes in and someone accepts it and delivers it. So we've been having very little problems with appraisals, fortunately, right now. I think primarily because appraisers can go back as far as 12 months on their comps that they use. Well, if they're going back right now, 12 months to 6 months, that's a lot of good sales data there. If they're finding stuff in the last 2 months to 6 months, that's when they're starting to see some problems potentially on values. So I think right now appraisals are coming in okay. We'll see what happens this spring when the timeline's been moved up and all they're using is comps from March to March. And so that's when I'm speculating we might be running into some problems with appraisals at that point. It's obviously property dependent on what it's under contract for. But anyway, just as a little heads up on that. And so with TRID, this is some new regulations that came in several years back as well, but we're required to get the closing disclosure out to the buyers at least 3 days prior to closing and 7 days if it's a mail out. So if they're not using
I'm sorry, we can't hear you guys. You guys are muted.
Oh,
Can you hear us now?
Yeah, can you go back, please?
what did you hear last?
The very beginning of this slide, when the final figures are provided to the buyers.
Okay, so it's called a closing disclosure, and we're required to get that out 3 days prior to closing. These days, we'll send out what's called a preliminary closing disclosure. As soon as we have the minimum requirements, mostly that has to do with homeowners insurance. Once they know exactly what that is, then they'll send out the closing disclosure. So that has to go out 3 days prior to closing, or if it's what's called a mail out, where we're not emailing it to them, then we have to get it out 7 days prior to closing. It's not as big of a deal as we thought it was going to be originally when this rule came into play, but that's what we have to get out, is at least 3 days. So if a CD doesn't go out until, then you cannot close until 3 days after. And so sometimes it does delay closings if your lender doesn't get that CD out for whatever reason, but that's pretty rare these days.
Yeah, what I was gonna say about those CDs when they're sent out and they're received by the buyer. Those figures that are on there, and they're all itemized. Some of them are not exactly right. So most of the time they're rounded up. Okay? So they may see a CD that's, oh my gosh, this is like $500 off of what you said it was gonna be. Oh, just give it a minute. Listen.
Yeah, lenders
We're
are,
doing as much of an estimate as we can, because there's a few items that are on there that are date and time specific, right? And depending on the date that we put down as a close, that's gonna adjust the fees that we're gonna charge.
and amount specific too. So I don't want to get too much detail here, but we estimate high as lenders because we're okay if we go high and the fees are lower, that's no problem. But if we estimate low and the fees are higher, then we either have to eat it as a lender. It's called a lender cure. Not either, that's what happens. We have to eat it as a lender if we disclose low and we're out of tolerance, called tolerance on that. The big one that can come up there is if you're dealing with any properties with transfer taxes. Doesn't happen as much down here, but in the mountains, Vail has a 2% transfer tax based on a $2 million property. It's a $40,000 fee that they have to pay. And if I didn't disclose that as a lender, then the lender is on the hook for that transfer tax.
Ouch.
Yeah, so it can be a huge deal.
Yeah.
What we do in that case usually is we start the loan over and then we start it and put that transfer tax in there and voila, there it is. But, so,
That's a divorce.
yeah.
All right, we need to comply with dates written into the contract. First date is.
Oh, I'm sorry, I didn't finish my slide. Yeah, so these are important too. Sorry, I just noticed that these last two things here. So funds to close can either be a cashier's check or wired funds. It went back and forth between title companies. It's the title company's decision whether they will accept a cashier's check or a wire. So for years there, they didn't want cashier's checks because they could be fraudulent. So they wanted people to wire funds. Well, now the wires transfers can be fraudulent. So now they're going back to saying cashier's checks are fine. But it's just talk to your title company that's that the listing agent is using. It's just to make sure that when they know what they're acceptable, because some smaller title companies will only accept cashier's checks up to like 25,000, and over that they want it wired. So it's just something you want to check into to find out what the title company requires there. And then the last thing here has to do with powers of attorney. So powers of attorney can be used if a husband and wife and the husband's whoever spouse is traveling, the other person has to sign. That's allowed for some transactions, but not all types of transactions. So if one of the title holders is going to be at closing and power of attorney is going to be needed, the title company puts those powers of attorney together, and you want to make sure well in advance that the lender is going to allow it to be able to be used. And for instance, cash out refis, you can't use the power of attorney. I don't think rental properties are allowed to use powers of attorney. So it's mostly just purchase, owner occupied properties. It's pretty common to be able to use power of attorney, but it takes the title company time to put that together. Then they have to send it out to whoever's out of town. They've got to sign it in front of a notary, give it back to the title company with the original. So there's some timing involved. That's why you need to know and well in advance and start jumping on that if there's going to be a power of attorney that's going to be involved. So, all right, all you.
My turn now?
Yes.
All right, thanks, Graham. Well done, by the way.
Thanks.
You're doing a great job.
Actually, can I throw in,
Sure.
speaking to the power of attorney, if you have a military family and one person is deployed, there are extra documents that have to be signed by the military personnel boss
Commanding officer.
within hours of, it's called a proof that they're
Attestation.
alive,
Yeah.
proof
Okay.
of living form or something. But it has to be signed by their boss within hours of them seeing each other. So that is kind of a hard thing to do. If you've got to chase down a two-star general to have them sign this document. So just,
Yeah, thank
we
you for
would-
saying that. I've never had to deal with that, fortunately, but
Yeah.
it happens, yeah.
All right, we need to comply with the dates written in the contract. First date is the loan application, which can either be done in person, over the phone, or online. Homeowners insurance needs to be put in place. This is, homeowners insurance needs to be put in place. This is one item that can vary significantly from carrier to carrier. So on this boat, this can vary significantly, the homeowners insurance, from carrier to carrier. So the buyer should shop around to make sure that they're getting a good price with comparable coverage. This needs to be completed early on, since we need to get the final figures out sooner with TRID. So TRID is our compliance.
Yeah, so we can't get that CD out until they've decided on their insurance. And, that can be a deal killer for some people. If their insurance is $4,000 and they're expecting it to be more like $2,000, that can throw their payments out of whack if their ratios are right on that edge. So insurance is one of those things I definitely want to check into. Based something right up, I always tell them, as soon as you're done with inspection or comfortable with inspection, get your insurance handled next, because we need to know what that's going to be. And the insurance companies can do that. As soon as they have an address involved, they'll be able to put it together. The primary thing, as you guys may know, is the roof these days in Colorado. They're gonna have that first question they're gonna ask, what's the roof like? How old's the roof? And so that's good information for the buyer to know before they call their insurance company, because that's gonna be a big factor in what the insurance cost is gonna be.
All right, so again, we've got, first off, we get loan application. Secondly, we get homeowners insurance. The next date that we're concerned about is the appraisal deadline. We typically need to order the appraisal 2 weeks prior to the contract deadline date. So as Grant was saying, it really kind of fluctuates a little bit, but still the earlier the better.
At least a week, I think, from the start. I mean, it really, again, it has more to do with the inspection, trying to tie the timing on the inspection with the appraisal and make sure if we have to order both, if you've got a 2-week closing or 17-day closing, we're going to order them at the same time. This is what's going to happen. But if it's a 30-day close, then we've got a little bit more wiggle room there to hold off on the appraisal until you're comfortable with inspection.
Yeah, so due to inspection problems, we can cancel the appraisal and not get charged if the appraiser has not visited the property yet. Okay. Loan availability deadline for the lender means we need to have a fully approved loan. This date would ideally be 3 days prior to closing the loan, or the closing date, if the lender has their way. This date would ideally be 3 days prior to the closing date if the lender has his way. We need to be fully approved and ready to head into our closing department at this time, which is why the date is usually fairly close to the closing date, particularly with TRID. So having the CD out, we have to have it out at least 3 days before the closing. We want to make sure we have enough time built in there to have that TRID prepared and have all the inspections and homeowners insurance and everything else into the office and put into the closing disclosure.
That's a slide. Oh, so people online, sorry, there's the slide that Chris was just talking about.
But you could hear me
Yeah, hopefully.
read poorly, right?
why do they only have 3 days? I'm a nervous Nelly, and 3 days just seems like you're cutting it so close.
You guys, I mean, it's whatever you guys decide, we're gonna comply too. You're talking about loan availability deadline?
Yeah.
Yeah, I mean, that's our wish, our best case would be push out the loan availability deadline as far as you can to close to the closing date. And since we got to get the CD out 3 days prior, we're not going to be able to get that out until we've had some kind of a initial approval in place. But if you're trying to compete on a contract and you want to do your loan availability deadline 10 days before closing, fine, we'll make it work as a lender. Yeah. Okay, so I want to talk a little bit about credit. It's obviously the importance of credit for a borrower. It can make or break the deal depending on what their credit scores are. So We talked about the scores that are involved and all that. But pulling the credit early in the process is really key, because if there is something that we can help them get fixed, get deleted, whatever, pay off some debt to get the credit scores up, we can do what's called a rescore of that credit report, get the scores higher, and then base all their pricing and interest rates and everything off that higher credit score. So it's kind of a fine line, because if you have a borrower, on the flip side of this, if you have someone say, I don't want to buy until next year, I'm not going to pull their credit now unless they think it's really bad and I want to pull it to try to help them get it fixed up in the next 3 or 4 months, then I'll do that. But if they think they've got great credit and they're not buying until January or February, credit reports are only good for 120 days. So I have to close, from the time I pull it, I've got to close on that loan within 120 days, or I've got to re-pull the credit. So we just have to decide when to pull the credit, and it really does depend on the borrower as to when we want to pull that. But there's, to get this, there's a few different ways to get the scores up. The main thing that will hold scores down is late payments, and on credit cards or whatever, late payments in general. Those are not going to go away. I mean, I always tell people, you can call the credit card company and see if they'll delete it. There's a 5% chance they might delete it. But chances are they're going to say, no, you didn't pay it on time. We're not going to delete it. Sometimes though, they will early report it. So credit isn't late until they're past 30 days past due on a credit card. So if they paid it 20 days later and they can show the lender that, or show the credit card company that, then the credit card company will probably delete it. They will delete it. But if they're over 30 days, it's not going to go away. So other things that pull credit down are collections, as I talked about. So there's 2 different kinds of collections. There's medical collections and there's consumer collections. Consumer collections probably aren't going to go away either. Like if you paid your your cable bill, didn't pay your cable bill, and you got a consumer collection, there's a high likelihood they won't delete that. It'll just be there for, I think it's 7 years, as long as how long it stays on your credit. But the only leverage you have as a consumer, or the consumer has, is that they owe that money. So before they just go off and pay it, they want to call that collection company and say, I will pay this if you delete it from the credit report. And if they can get it in writing, then we can take that letter that's saying we've deleted it from the bureaus and use that to rescore the person's credit. That's one way to get the scores up. Medical collections are a different story. So the rules just changed on that to the consumer's benefit just recently, where let me say what the old rule was. So if someone had a collection on there and they paid it, and this has been the last 5 or 6 years, then as soon as that's paid, the credit companies are required to delete that from the credit report. They weren't always doing that. They just hem and haw about it and not always do it. But now the new rule is, and I don't know, I can't remember exactly what the rule is, but basically they're no longer allowed to report medical collections, I believe, if they're under $500, 500 or under, then it's not even supposed to show up on someone's credit report. And then it'll get deleted automatically, I think, once it's paid off. So medical collections are a lot easier to get cleaned up than consumer collections are. And then the other thing to do for just in general, people's credit scores can get dinged quite a bit if they just have high balances on their credit cards relative to the limits. So relatively easy way to get your scores up is if people just pay down their balances, and we'll see the scores go up. So if they get it below 70% of the limit, that helps a little bit. 50% is the next threshold. 30% is what they say is kind of the ideal threshold. If you get it below 30%, then the scores will go up, and they go up pretty quick. And usually reports within the next billing cycle, you'll see the scores increase for folks. So that's if they have the money available, obviously, to be able to pay the scores or credit cards down, then that's one way to get the scores up somewhat quickly. So
I've seen it work. The program that's associated with our credit vendor, to rescore, what will they give if we do this, this, and this? And it tells us what the score is. Actually, it tells us a few different scores, and it says, in order to get to this, you're going to need to do this.
that's on your slide.
And essentially,
It's called what if analysis.
well, there you go.
Yeah.
I don't need to read it, 'cause I'm doing a poor job of that. So, yeah, I mean, it'll give us, very specific rules. And it'll bring your score from 673 to 712. Well, that's fantastic. That brings you in a whole new bracket and possibly, less money down. There's a couple of different wins based on that. But it really is pretty amazing. A lot of things that people think give them good credit, actually doesn't, you know, having a bunch of credit cards, like, I pay every month, yeah, but they're almost maxed out, you know, I mean, that's not good.
Applying for
Paying
new
off
credit,
accounts.
people talk, you heard about people, when you apply for new credit, that pulls your scores down. And that will impact people that have lower credit scores, that'll impact them a lot more than people that have 780 scores. You get a new credit card, you might see your score go down 4 or 5 points. But if someone's at a 660 score and they're maxed out and they're applying for more credit, that's when you can really get their scores negatively impacted.
Is there a what if scenario system app or company out there for consumers just because, like?
I don't know if Credit Karma does that or not. But it's for, you know, with us, once we pull the report, then we have, for 30 days, we have access to do this what if analysis to see what we can do to try to get the scores up. And we can use the rescores, whatever the new score is, but that's only for conventional loans. We can, with jumbo loans, the score we pull is the score we're going to use. So they don't allow us to rescore on jumbo.
So, I don't know if I missed anything on that, but it's only three lines, but it's fine. Something that we did put on here that is worth discussing is pulling credit for the mortgage. Right, so if you've got a buyer or you run into somebody that says, I don't want to change. I already had my credit pulled once, I don't want to drop my credit score. You've got 30 days to shop for a mortgage. You can get your credit pulled numerous times and have your score not affected but that one time. Right? And that's only fair, and that makes sense. And we be able
It's
to
so
cost you.
viable. That is the number one question.
Yeah, so that's, they used to take advantage of people like that. You know, they would pull their credit 10 times, 15 times. They would still use the first score they pulled, but they knew that the borrower couldn't go anywhere else because now we had a 500 credit score. Pretty shady, right? And people were willing to do whatever it took to close the loan. Same thing happened in car dealerships, and now that's changed as well. But, you know, there are certain things that you need to know. All of this, you don't really need to know. But now you do.
I don't really need to know this, but I've always wondered, like, let's say I have I have one account that's on my credit score that's been open forever. And why does closing an account lower your score?
That's the one here I was going to mention. So because you're getting rid of very good credit history. So there's different,
okay.
we could do a whole new class on what factors into a credit score, but the history of credit accounts that you have, I'm guessing it's probably 10 to 15% of what your score is. Paying on time is probably 40% of your scores. Balances on the cards, I guess, is probably 20 to 30% of your scores. But yeah, people don't want to close out. If they have a credit card for over 5 years and there's no annual fees involved, just hold on to it, because it's just building people's credit, because the more history they have, the better. And then paying off old collections, that can actually hurt people's credit scores, because what's happening is if it's over 2 or 3 years old, it's just sitting there. I mean, their scores are still low because of it, but but as soon as they pay it off, it's basically refreshing it to current, because it's now considered a fresh debt that's been paid off, and that can actually bring their scores down even more. So I always tell people, if they're not going to delete it for you by paying it off, just don't touch it. Just let it sit there, and eventually it's going to fall off the credit history. So that is all we have,
Pretty much
I
it.
believe. Yeah.
Thank you.
So we've got one last drawing to do, but before we do that, does anybody have any questions? And I feel like we're neglecting you guys remotely.
Yes.
Does anybody out there in the space world have virtual questions?
You might,
No, thank you.
you guys might have mentioned this before I walked in, but say like you have an applicant applying, 2 people applying together, and one has say a 780 and one has a 680. Would you just take the average of the two?
680.
Oh, you take the lower one. Oh,
You do, that sucks.
So then we try to say if we can qualify just the one borrower with the 780.
yeah, because you can't use the income of the person with this.
We can't. Nope, not if we're not on the loan. Yep.
Can you help me on, if you have a married couple who divorce and the wife goes to buy a house, can she be a first-time home buyer? How does she?
Depends on if she was on title to the property or not. If she wasn't on title, if it was just in the husband's own and title, then she's a first-time home buyer.
Okay,
But, you know, for a first-time home buyer is almost, it's overrated almost in a sense, because it's not, the only thing it's doing for you is it's allowing you to get to a 3% down payment or a down payment assistance loan, which I guess can be valid, but
yeah,
if they've got some money from divorce, they're selling the house and they've got some equity, as long as they have 5% down, they're probably not even gonna be looking at a first-time home buyer program anyway, yeah. But one thing I mentioned on that situation too is we're dealing with someone right now, divorce situation, she's not working, hasn't worked, she's gonna be getting alimony and, you know, maintenance and things like that. But I can't use that income for qualifying until at least 6 months after the divorce is finalized. Because the reason being, they want to make sure that the husband's gonna be paying, he may be obligated to pay that for the paperwork, but until he's actually paying it, they're not gonna let her use that income for qualifying.
Nice.
Yeah. So that could be an issue sometimes. What else?
can they get loans based on just alimony payments?
Sure, yeah, absolutely. Mhm. Yeah, as long as it's gonna be for 3 years. Three-year continuance is the other piece of that.
Okay,
That has to do with any kind of note receivable income, any income that's not standard pay, you know, pay stub or whatever. If they have a note receivable that they have and they've got 3 years or over 3 years of continuance, we can use that for qualifying. On the divorce thing, that's what I was gonna say. So let's say husband's gonna, whatever, wife's gonna keep the house or whatever, but, and then she's responsible to make the payments, then the husband can go off and go buy something and not have to count that payment against him, even if he's on that loan, because the divorce decree states that she's now responsible for that payment. So either party involved, the other person can go buy if the other person is obligated per the document to qualify.
So if you're on social security like I am, and you don't have enough income, I was told you can create a stream of income by just having recurring monthly distributions from your retirement account.
That's exactly right. Yep, yep. And so we'll do that for newly retired folks, like say someone's getting, you know, they just retired and all of a sudden they're not pulling money out of their retirement accounts yet because they don't need it. You know? But if to qualify, if they start pulling whatever it is, $5,000 a month, as long as we can show 1, sometimes 2 months consistently of those payments coming into their account and get a letter from their financial advisor stating they're going to start taking monthly distributions of $5,000, then we can instantly use that income to qualify. And then they can just stop doing it. Once they buy the house, they just cancel that and they don't have to keep qualifying out. Yeah, and that's a great way to qualify to get more income to qualify.
So I'm sorry, I didn't get your name.
I'm Augustine.
Augustine, I'm Chris.
Chris, nice to meet you.
So it sounds like you were trying to configure a way to get this person to be a buyer.
I was thinking hypothetically. I
Yeah,
wasn't thinking
okay,
of a
all right.
specific.
So, I mean, if you get come into a situation where it's like, maybe if I tell them to do this, or do this, they'll be a buyer. Just call us.
Yeah.
You know,
Mhm.
and we won't pressure anybody into anything they don't want to do.
Right,
We will advise you, I mean, we will help you and your buyer, whatever way that we can. And hopefully that'll bring enough trust between you and your buyer and us, that we all do business together, you know, sometime down the road, whether it's right now or 2 years from now.
thank you.
Good.
Are HELOC rates different than mortgage rates?
HELOCs are typically tied to the prime rate and they're variable rate loans. So prime right now, can I get this right? I think with all these Fed raises, I think we're up to 6.25 now on the prime rate and then HELOCs are usually at prime or prime plus a certain amount.
Okay.
So the best you're probably gonna do on a HELOC right now is 6.25. Could be 7.25. That depends on the credit score. It also depends on the amount that they're gonna borrow and also the amount, the loan to value they're gonna go to. So as long as you're staying, is your line of credit's below 80% of the value, you usually get the best terms, but you can borrow up to 90%, sometimes even 95% of the value. That's probably gonna change, honestly, with the current environment that we're in. I bet you a lot of banks are gonna start cutting back to 90 tops. We don't do lines of credit. We just do first mortgages. We do have one investor that will allow us to do a fixed rate second mortgage, not a line of credit, but if you know someone that's, you know, cash out refis, people there's no reason to do that right now. If they've got their 3.25% rate here, they don't want to do a cash out refi at 6.5 or whatever. It makes no sense. And I'll tell people that, do a second mortgage. If you need to pull some equity out, put a second mortgage in place now, even if you're paying 6.25 or 7.25 or whatever it is, at least you still have the lump sum of your money stuck at 3.25. And then when the rates do come back down, then we can roll both loans into one, do the cash out refi when the rates are back in the 4s, versus the 6s that we're in.
I might call you.
Can you open a HELOC and then use that as down payment money?
Sure, as long as you don't have the house listed on the market.
Is there a time frame of how long you open the loan to when you can cash it out and use it as, like, does it have
As
to be?
soon as the
open for 6
rescission
months?
periods, nope, as soon as your rescission period is up, there's a rescission period with lines of credit, so, because it's owner occupied residence, but 3 days on a refinance, if I do a cash out refi for someone, they can have the money 3 days after they sign. And same thing with the line of credit, they have access to it 3 days after. But the key thing there is, we'll structure things all the time, if people have enough income to be able to buy their new house with that loan, carry their existing house and carry a line of credit, and they can use that line of credit as their down payment on the new house. It's almost like a bridge loan, but it's a lot less expensive bridge product, the line of credit is, versus a true bridge loan. There's just a lot more fees and expenses involved in that, but they do have to have that line of credit in place before they list it. That's because
That's how I bought investment properties. My first house I bought for $68,000. That wasn't like 1950, it was 2001. Not as old as I look. So bought it for 68, and just a couple of years later, it appraised at 115. And that's when I went and I applied for the home equity line of credit. And that gave me enough money to put money down on the next home. Then I rented that first one out. And then after I outgrew that house, we did a home equity line. I keep saying we because it was me and my wife and my kids.
Repeat it.
No longer, but did another home equity line and essentially just built up investment properties just like that. You had to have the equity there. And the home equity line of credit was always an adjustable rate. You could get a fixed rate, but it wasn't a good term. But yeah, I was able to actually monetize, the equity out of that first house.
Does it take
And make
years like
investment
this
properties.
to start out?
home equity lines are 10 years. You have typically have the ability to draw on those lines of credit for 10 years. And after that period of time, if you still have the loan in place, they will just cap that availability, and then it will turn into usually a 15 or 20-year fixed rate loan at whatever the market rates are at that time. Usually people will just end up doing another line of credit, paying off that one, opening up another one, and having another 10 years of availability to draw money. Yeah.
I'm very naive with this, but I have 100% equity in my home because I paid cash for it. And if I wanted to pull some of that equity to help buy another property, but I retired, I'd probably have to create a stream of income.
Let's talk afterwards.
Yes, sir. 'Cause that is very
Well,
complicated.
the reverse mortgage that I talked about
Yeah.
might fit your situation perfectly, because with a reverse mortgage, you don't have a payment on that. So there's nothing to qualify for other than the
Right.
taxes and insurance on your house. And reverse mortgages require very little income to qualify. Oftentimes people can qualify for a reverse mortgage only on Social Security. You don't have to worry about pulling any money out for
Well,
distributions.
that's true.
So,
Yeah.
and then it's a line of credit on a house, a reverse mortgage is. So if you're free and clear and your house is worth $400,000, you can have a line of credit of upwards of $150,000 to $200,000 and just sitting there waiting for you to use it whenever you want it. And then if you do pull the full amount out, you have to wait a certain period of time, but after 12 months, you can access the entire amount. There's still no mortgage payment on that. You're just paying your
Right.
taxes and insurance. It's like, it's a great
We should
product.
talk.
For people, for the right borrower, for sure. So,
So, hey, I don't want to stop
Yeah.
this thing, not a hard stop, or kind of a soft stop, but it's 4 o'clock and I don't want to keep people staring at their, their monitors there for any longer than they need to. What's that?
it's 4:01. Come on, TikTok, let's go.
He's got his time clock at the end of the second, 8 days. You guys.
We got open house flyers to make here.
I'm just kidding, I didn't have anything so far.
Finish shots.
Is that?
That's a good
Finish
shot.
shots.
Yeah, sure, we'll pick up. Sign them up. You know what I'm talking about.
Yes.
All right, so the winner is Ed Hanson.
Yeah, okay.
Aw,
He's
that's
online.
fun.
Ed,
Ed,
He bailed.
Ed.
He bailed.
he was online.
That's all right. We'll give it to him. And I
Uh,
want to draw, so go ahead.
No, I'm kidding.
One other thing I want to draw for is I want to give away a Yeti mug. So that's going to go to Meg.
Hey, I was just gonna say. All right. Thank you.
Yeah, thanks everyone for participating. Yeah, I'm surprised it took 2 hours, but that was a quick 2 hours as far as I'm concerned. So, yeah, you bet.
Thanks, guys.
Thanks, guys. Thanks for coming.
Thank you.
Ed, you see?
There he
Thank you.
is. Yeah, you bet. We'll bring it up to you next time we're up in Fort Collins, or if you're down here as well, just let us know.
Okay, thank you.
You bet.
Thank you, guys.
Oh, he's a good dog. That dog is just 100% love.